Everyone, welcome to the Stock Trading Tutor channel. In this video, we'll be looking at the technical analysis basics. So we'll be studying the golden cross and the death cross. So these are exact opposites of each other. So we'll be looking at both of them side by side to understand and get better clarity on how this appears in the candlestick chart. So first, let's see what is a golden cross. So the golden cross is a candlestick pattern that is a bullish signal in which a relatively short-term moving average crosses above a long-term moving average. So the golden cross is a bullish breakout pattern formed from a crossover involving a securities or a stock's short-term moving average, let's say a 50-day moving average, breaking above its long-term moving average like a 200-day moving average or resistance level. So as the long-term indicators carry more weight, the golden cross indicates a bull market on the horizon and is reinforced by high trading volumes. So here is an example of what a golden cross will look like. So this black line here is the 200-day moving average, and this blue line indicates the 50-day moving average. So when the smaller time periods moving average crosses above the longer time periods moving average, we have the golden cross appearing. So this is what a golden cross will look like when you apply it on a candlestick chart. So this chart was sourced from the TradingView. That's a completely free charting platform which you can also use for um, looking at the daily candlestick charts and other chart patterns to analyze the market. So as you can see, once you apply both of these moving averages on a chart, you can get a clear picture of what a golden cross will look like. So the golden cross is a technical chart pattern indicating the potential for a major rally. The golden cross appears on a chart when a stock's short-term moving average crosses above its long-term moving average. So the golden cross can be contrasted with a death cross indicating a bearish price movement. So now let's see what a death cross is. So this is again another technical chart pattern indicating potential for a major sell-off. So the death cross appears on a chart when a stock's short-term moving average crosses below its long-term moving average. So because the death cross is a long-term indicator as opposed to many short-term chart patterns such as the doji, it carries more weight for investors concerned about locking in gains before a new bear market gets underway. An increase in the volume typically accompanies the appearance of the death cross. So here we have another example of the candlestick chart showing the death cross. So in this, the red line is the 50-day moving average and the blue line is the 200-day moving average. So when the smaller period moving average line moves below the longer period moving average line, we'll get a death cross. So here we have marked again. So this is what a death cross will look like in a candlestick chart. It's quite evident once you apply it on the chart for a longer term period, you'll get an indication of how the market is moving for the longer term. So a death cross is again the technical chart pattern indicating the potential for a major sell-off. So this indicates a bearish turn in the market. The death cross appears on a chart when the stock's short-term moving average crosses below its long-term moving average. It has proven to be a reliable predictor of some of the severe bear markets in the past century, and it can be contrasted with the golden cross indicating a bullish price movement. So the death cross name derives itself from the X shape created from the short-term moving average descending below the long-term moving average. This pattern precedes a prolonged downturn for both the long-term and short-term moving averages. So the death cross is a signal that the short-term momentum in a stock or a stock index is slowing down. Now the death cross is not always a reliable indicator that a bullish market is about to end. Regardless of the variations in the price definition or the time frame applied, the term always refers to a short-term moving average crossing over a long-term moving average. So here, to get an idea of how the golden cross and the death cross will appear on a candlestick chart, we've applied it on the Nifty 50 index one-day candlestick chart. So each candlestick indicates one day, and we can see how the golden cross and the death cross would appear in it. The blue line here indicates the 50-day moving average, and the red line indicates the 200-day moving average. So here we have the golden cross indicating a bearish movement. So we have the stock price moving upward, and then we have in this place we have the death cross. So this indicates a downward movement of the stock. However, as we have already seen that the death cross is not always a reliable indicator that the bull market is about to end. So, as we have seen here, even though the death cross has appeared here, the market seems to have moved above it. So, this can sometimes happen. So, however, the death cross just generally indicates a downward movement. And because of this downward movement we have here in the candlestick pattern, this has brought about the death cross in this region. So there are three stages to a golden cross first. The first stage requires that a downward trend eventually bottoms out as the selling is depleted. In the second stage, the shorter moving average forms a crossover up through the larger moving average to trigger a breakout and the confirmation of trend reversal. The last stage is the continuing upward trend for the follow through to higher prices. So let's see, the first stage requires a downward trend, eventually bottoms out as selling is depleted. So here we can see the downward trend has basically bottomed out in this golden cross movement. And in the second stage, the shorter moving average forms a crossover up through the larger moving average to trigger a breakout and confirmation of trend reversal. So here again, because of this crossover, it is a confirmation of the upward trend movement. We can see a continuous upward trend movement, and the last stage is the continuing uptrend for the follow through to higher prices. Here we see that after a golden cross, there's been a deliberate upward movement until it plateaus around here. It hits a peak in this area and then it plateaus, slowly going down. So the death cross is the opposite of the golden cross, as the shorter moving average forms a crossover down through the longer moving average, as we have already seen. So again, the difference between the golden cross and the death cross, they are exact opposites, and a golden cross indicates a long-term bull market going forward, while the death cross indicates a long-term bear market going forward. So both refer to solid confirmation of a long-term trend by occurrence of a short-term moving average basically crosses over the long-term moving average. Here we can see how the death cross and the golden cross appear when the market is quite volatile, and here the signals are not exactly very, uh, can be a little volatile here. We can't be sure whether it's a proper signal or if it's a false signal in this case. So again, this is one of the limitations of both the golden cross and the death cross. All the indicators are lagging and no indicator can truly predict the future. So many times an observed golden cross produces a false signal. So here, however, this is pretty accurate. Here in this, the death cross, this doesn't technically indicate a continuous prolonged downward movement. This is technically a false signal in this region. And okay, as we have seen, it can produce a false signal. A trader placing a long at the time could subsequently find himself in some near term trouble despite its apparent predictive power in the forecasting prior to the large bull markets. Golden and death crosses do regularly fail to manifest. This can happen. You should always confirm with other signals and indicators before putting on a trade. The key to using the crosses correctly with additional filters and indicators is to use all proper risk parameters and ratios. Remember to always keep to a favorable risk to reward ratio and to time your trade properly. So this can lead to better results than just following the cross blindly. So instead of just using both the death cross or the golden cross blindly, it's better to use extra filters and indicators so that you can before you trade so that you can confirm your signals. So again, we can see the limitations much more clearly in this stock chart. We can see that there are multiple signals appearing pretty frequently when the market is very volatile. So this can create some false signals and we can't be quite sure whether these are reliable or not. So here we have three signals within a short period of time, and here again there's a quick reversal up and down, down. So better to confirm these signals with other indicators and filters so that you can trade properly and get better results. So here are the sources if you'd like to learn more about the golden cross and the death cross from which we gained information for this video. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to start trading in the stock market, you can create your Demat account with Alice Blue by clicking the link in the description and filling out your details. With Alice Blue's brokerage services, you'll get excellent exposures and margin for trading in the stock market.